Uh, Hello, everybody. This is Dima Lishinsky, and this is our Hangout. And the main topic will be about Module 4 that started a couple of days ago. But I'm also planning to answer your questions about Project 1 that is due this Sunday. And I wanted to make a couple of comments about discussion, participation, and maybe provide some explanation. So why shouldn't we start with Project 1? I have two questions that were submitted online, and therefore I will start with these questions. Question number 1 is whether a crystal ball is still optional. And the answer is yes, crystal ball is absolutely optional because I understand some technical difficulties that all of us are experiencing trying to use remote desktop. This is beyond our control. It's a very good software to try, and that's why I'm strongly encouraging you to try at least this 2-week trial version downloading from Oracle to learn about this software. But having said that, I want you not to be penalized for technical. I don't want you to be penalized. Therefore, the crystal ball submission is optional. By the way, please don't mute me. Somebody just muted me. I hope that was just by mistake. Everybody can hear me, correct? Except maybe one person.
Yes.
Oh, okay. Thank you. Now, second question was about operating cash flow. And let me bring your attention to the example that we had in Module 2 about capital budgeting, how we were calculating free cash flow in that example. That example is the very first example that we actually we used. And in that example, what we were doing, we were calculating net operating profit after taxes and then finding what the free cash flow will be from net operating profit after taxes. Another example is in practice example, the same approach. Therefore, to find your operating cash flow, which is from operational perspective is the same as net operating profit after taxes plus your depreciation, technically speaking, this is where your OCF would be. You would have your earnings before interest and taxes multiplied by 1 minus the tax rate, plus you add back depreciation. One typical mistake was that people would think, oh, my operating cash flow will be my net income plus depreciation. But if I have my net income plus depreciation, you'll see that the answer is different from operating cash flow. Operating cash flow is 23,193. Why? If you simply add depreciation to net income, you'll have a different number. And the reason why the number is different is because free cash flow ignores interest payments. We have to ignore them. But we cannot just say, oh, because I ignore them, I can simply add back interest. That will be a mistake too. And the reason why that would be a mistake, well, I add it as a negative number to really add it back. The reason why that will be a mistake too, because now it's even higher than my operating cash flow. Interest was tax deductible, so it affected taxes. If I want to completely ignore my interest payment, I have to multiply it by 1 minus the tax rate. And then my answer will be the same as how I calculated it in my example here. Compare this formula and that formula. You see that formulas are slightly different, but result is the same. And therefore, it is much easier if you simply use your earnings before interest and taxes multiplied by 1 minus the tax rate plus your depreciation. And that will give you your operating cash flow. And that would be the alternative to do that. If you really want to start from net income, you have to take into account the fact that interest is tax deductible, so you have to add back after-tax interest. I hope that clarified this uncertainty about the operating cash flow. Okay. Any more questions about project 1? I'm opening now floor for questions. Okay.
Yeah, I have a question.
Yes, please.
About the projected electricity cost per kilowatt.
Right.
For some reason, I don't know how to get the projected electricity costs under the projected net income, line number 60. I'm a little confused. I don't know how to come up with that calculation. I know that I'm supposed to use information from the energy prices forecast, but I don't know how to use the reference case or the high oil price, the low oil price, the high oil and gas, or low oil and gas, the high resource without clean. I don't know how to consolidate that information and get the correct.
All right. So you don't. Ronald, can you mute? I understood your question.
Okay.
Because I hear the echo. You don't really have to consolidate all these 6 cases together. You do them one at a time. It just here, it's convenient way to put them together. So when you'll be creating 6 summaries, 6 scenarios for one scenario summary, it's easier to have all of them together. You do it one at a time. And how you do it, you look at the energy prices forecast. And here are the prices. Here is the forecast, but the forecast is in cents per kilowatt, not in dollars, but in cents. And also it's nationwide forecast. We know from the case that we have 70%. Let me find it. Where is this information? That discount, yes, here it is. The discount is 70% of national average. It's not the discount, the factor. The multiplication factor is 70% of national average. So to find, for example, if you want to find the price for 2019 for reference case, what you have to do, you have to convert this value, 1101, from cents into dollars. I guess everybody now knows how to do it. And that's simply, dividing by 100. And then you take into account the 70% discount factor by multiplying by the discount factor. And that will give you this reference case for 2019. Then you'll do the same for the reference case for 2020, 2021, 2022. And after that, you'll do the same for all other cases. Notice that in the table, which I downloaded directly from US Energy Information Administration, the years are organized this way. So each case is a separate column, while different years are in rows. Well, here you have to kind of transpose it, convert it, because here one row corresponds to one case. So just make sure you convert it correctly.
So, so you're saying multiply for reference case 2019 by that 70%, right?
Right. But make sure that you use dollars, not cents.
Yeah.
Yeah. Because this one,
70%.
yeah, because this one is in cents. You have to convert cents into dollars.
So right there, it's at 11.1. That's $11.01.
No, it's 11 cents. This price is in cents. It's given right here. Prices are in cents per kilowatt. You have to convert it into dollars. So it's not 11, it is 11 cents. So you have to convert it by dividing it by 100.
Okay.
Yeah.
Okay. So you take the 11 point, oh wait, no, point, what's that? Point.
So you take this number and then you divide it by 100.
Divide that by 100. Oh,
yeah.
Calculator.
And then you get this number.
0.01 divided by 100. Like my calculator, hold on 1 second. 6 decimals.
The more decimals you use, the better. If you use it in Excel, it's
okay. I see the decimals. So it's like at the 6th place, right? Yeah. And I times that by 0.70, and that's how I get the answer for the reference case for 2019.
Yeah.
You have it right.
Right.
That's the answer right there?
Yeah, that's the answer right there. That's what you have to use. When you are doing the basis case, that's what you should do. If you are doing scenario analysis later, Ronald, can you mute yourself? I hear very loud echo. No, it's okay. I just hear myself, and it's, yeah. So if once you do the basic analysis, you then to prepare scenario summary, you'll have to redo it for every case by changing numbers in line 60 by referencing different numbers from this table. You will have new NPV, new IRR, and that's why you have to do it to get NPV and IRR. Okay. Now, one important thing here, and that confuses people. Some people say, why do we need these 7 cents because we don't really use them? Well, we needed that because we need to figure out how much electricity is used per car. Because what we know that the old car the cost was $14,000 based on this price of electricity, 7 cents. We will not use 7 cents, but it will allow us to calculate how many kilowatts will be used per car. Because if 14,000 is the total cost and electricity is 80% of this total cost, then 14,000 times 80%, that will be my electricity cost per car And then if I divided it by the cost per kilowatt, it will tell me how many kilowatts I will have to spend, to use in order to manufacture one car. Because here we have dollars, and I need to get kilowatts. So I take dollars and I divide it by the price per kilowatt. Dollars will cancel each other, and then the answer will be in kilowatts. I have two more questions submitted online. I'm still confused on calculating net working capital. I tried the explanation given in the major project 1 frequently asked questions, but it's not seem correct. Okay, so what we have here, we have to figure out what investment in net working capital will be. The cash flow, the cash investment. In order to do that, what we do, we use the information given in the case. Let me open the case. That just give me a second. That net working capital outlay will be required at the beginning of each year. Will be you will need net working capital outlay equal to 4.75% of direct manufacturing costs, direct costs. So what then I will do if I have my direct costs, and they will be right here, then I know that my net working capital outlay will be 4.75% of that number. But outlay is not always actually the cash flow. What is the cash flow is only the change in my net working capital. That's what investment in net working capital is. That means that at the very beginning, I do need the entire outlay because I didn't have this project yet. I have to create the outlay. It will be this percentage of total direct costs. But after that, in the second year, I already invested some amount in net working capital. I already have this net working capital. That means that all I need to cover is only additional net working capital. So what I will need as an additional investment is the difference between total direct costs in year 2 minus year 1, again multiplied by this 4.75% percentage. And that will continue until the very last year. And last year, because this project is over, that will be recovered after 4 years. That's right here. The net working capital outlay will be recovered after 4 years. That means that at the end, I will get all my outlay back. And this is how you should treat net working capital. The next question is, can you show us how to calculate CapEx? Well, I cannot really show you because there is pretty much nothing to show. Let's have a look again at the description. The cost of setting up the plant is to be $250 million. And that's it. And that's at the very beginning. I set up the plant. It will cost me $250 million to invest to set it up. That's my capex. That's all. There is no other capex in this example.
Yes, I'm sorry. My computer was acting up.
Yeah.
But when you showed us the 6 scenarios and, the times, the reference case and, 6 scenarios by 0.70, I didn't see how you got the projected electricity cost per kilowatt on line 60. How did you come up with that calculation there?
Did you get this? Did you see how we got this 0.0771?
Yes.
Well, then I just copy that.
Oh, you just copy that?
Yeah, I just put that number there.
Oh, okay, all right.
That's all. Yeah, because I will be changing the calculate for 6 different scenarios. I will be changing. For reference, I will be copying these numbers. For high oil price, I will be copying those numbers.
Okay.
Yeah.
Okay.
Yeah. Okay.
Professor, I missed how we got the 0.0771 for the electric cost. I missed that part.
Because the price, the cost here in this table is in cents per kilowatt. So first step, I need to convert it into dollars. From cents to dollars, I converted it by dividing by 100. And then I will have to multiply it by the regional discount factor, which is 70%. That's how I got it.
Okay.
Yeah. Okay. So the rest of cells for CapEx in years 1 to 4 should be, yeah, it should, yes. I apologize. Yes, I did highlight them to trick you. The question is why CapEx is highlighted in yellow. Well, not to trick you, but to test your knowledge. Yeah. Yeah. Because CapEx is only at time 0. That's not always the case, but in this particular case, that's how it worked. Yeah. There was only one investment. For project 2, you'll have more than one CapEx, so you'll have to get used to multiple CapEx, but not in this case. That's interesting. I got a question, but I don't see it. Okay. So I'm repeating one more time how you calculate the net working capital investment. Maybe it will be easier for you if you create some extra line, and you'll just call it net working capital, and then you calculate it as whatever it is, total direct cost times whatever the coefficient is. And then once you calculate that, and it will be for all these years, including the last year, because the last year it will refer to the cell that goes after, so it will be down to 0. And then investment then will be simply the difference between what you have in that year and the previous year, where it is 0. Then here it will be difference between this year and the previous year. if that is easier for you, they can just break it into one extra step. But pretty much, again, investment in net working capital is this coefficient of 4.75 times the difference between the total costs. Other questions? So let me make a couple of announcements, and then you'll think about it and maybe ask more questions, and then we'll move to module 4. I looked at your discussion, so pretty much I read everything that was submitted for module 2, all discussions. I read original posts and comments, and even if I didn't comment on some posts, I did read all of them, and I updated your participation grades, so now they include everything that you submitted by yesterday, by last night, for modules 1 and module 2. One more time, how I grade your participation. Quality is important. Timeliness is also important. So if you submitted your posts right before the deadline, so if the 4th of March was the deadline, you submitted right before the deadline, unless your post was exceptionally good, you probably will just get a kind of B-level grade. Because it's too late, people will not be able to read and digest what you submitted and comment on that, because comments will be after the submission is over, the deadline is over, so to speak. The same, even more importantly, for the comments that you, how you comment on other students' submissions, questions are highly appreciated. Critical comments are highly appreciated. Of course, you have to be polite. You have to demonstrate respect. But at the same time, if you disagree with something, please express your opinion. And some of you do that, and I really like that you are saying, oh, I think that should be treated differently because, for example, with bottom-up, top-down and bottom-up forecast, there was some confusion whether it is related to forecast or whether it's related to the income statement itself or whether it's related to the planning. And that's why I try to be specific. I said it is related to forecasting and it has a special meaning applied to forecasting, and some people would not understand it right. And then another person would comment and would say, oh, I think that's what actually bottom up and top down means. So I appreciate quality of your comments and how early they are. When I grade your initial posts, I also see whether you responded to comments that were left for you before the deadline and within kind of reasonable time before the deadline. So again, if the deadline was the 4th of March and we had the deadline the 4th of March and somebody asked a question on the 4th of March, well, I understand you didn't really have time to respond. So I will not really deduct something from your score for that particular topic. But if the question was asked about a week before the deadline, I would expect that you would respond to that question. Quality is important. The same with comments that you have in your original posts. Extremely important is that you provide reference to your post. Because, for example, sometimes I would see some comments that were nearly identical, so it's obvious that you read the same source. It's not your original thoughts. Please provide references. I perfectly understand you had to read external sources, but please provide references to them. Don't forget about that. You read the academic integrity module at the very beginning, and you submitted the pledge that you will have to follow these guidelines. Providing references is following these guidelines. And I would like to hear your thoughts. I would like to read your personal examples. Some of them are excellent examples that I already read. I really like them a lot. Please share more your personal thoughts, your personal experiences. Do I expect that you would respond to all posts? All topics? Yes, I do. And once we talk about module 4, I will mention them and their deadlines. But I see that there is one more question related to the project, so let me address that. Is there an example of how to calculate lost profit from cannibalized sales in sample information you provided so far? Good question. Capital budgeting. No, we don't have anything that is replaced here. Right. Well, a Delphi grill is, in a sense, this type of an example, although the approach is different here. Delphi grill is considered replacing an existing grill with a new, more sophisticated grill. The old grill was purchased 3 years ago, and so there is a cost. And therefore, what you need here, when we went through that example, we looked at the cash flow. The only difference is that instead of looking at revenues for one grill and then revenues for another grill, in this example, we looked at the difference right away. So we did not calculate cash flow for the new grill minus lost cash flow for the old grill. But the approach is very, very similar here, except that in our project 1, what I thought would be easier for you to do is to look at this lost profit from sales of discontinued model being put separately in a separate line, and the same alternative land use, because you lose this opportunity, that will be a separate line. So that would be the example that is slightly different, but with the same idea as we had before. And in terms of calculations, your lost profit, you have to think about it. So you have direct costs, you have direct price. The lost profit will be price minus cost times how many cars you were not able to sell. And don't forget that there are also taxes. So you have to multiply it by 1 minus the tax rate. And that's it. So that's pretty much straightforward once you calculated direct costs. Okay. I'm ready to move to module 4 unless there are last questions about the project. Okay, let us move on. Okay, questions. Not that one I should receive. So module 4, before we go to module 4, I wanted to show you some dates and deadlines because sometimes it's confusing what the actual dates are and what the deadlines are. Module 4 will last 3 weeks. We are in the first week of this module. In total, there will be 6 discussion topics. And this week you have only one topic because I was thinking you have this major project due. Probably it's good to have only one discussion topic. And this is interest rate tax shield. And I expect you not just to provide your thoughts, but maybe even support your thoughts by some calculations and numbers. And this topic is due this Sunday. So I expect you to submit your posts for this topic by the end of this week. Then we have next week when you'll have 2 discussion topics. And one of these topics is related to the homework that you'll have to submit. So I recommend you to do them together, do the homework and then do the topic which will cover the results of your homework. The second topic is about this approach of valuing companies, dividend discount model. And then finally, in the last week, we moved from discount cash flow and dividend growth model type of valuation of a company to valuation using multiples. And I'm sorry, you have 5 topics, not 6. There are 2 topics in the last week. I crossed out one. And valuation using multiples, that's kind of the main topic of the last week. And your homework will be about valuation using multiples. And both discussion topics are related to the valuation using multiples. One is for companies that are international, how difficult it is to find the real comparables for them. And I'm using my professional example from my previous job to apply to this valuation. And second is to use valuation using multiples, which is also called relative valuation, applied to a company that goes public, so for an IPO. And this will be due on April 1st. So you see, you don't have more than 2 topics per week. And that's why I recommend you to work on them in timely fashion. And I will be looking when you are submitting them. So please submit them on time by the end of corresponding week. Any questions so far before we talk about what this module 4 is about? Any questions? Okay. It looks like there are no questions. So let me close this file. Let me close project 1 template and module 2 template. So module 4 is about valuation, as all our modules are. But now from valuation of a project, we are moving to valuation of a company. And I just lost my screen. Well, sorry about that. I just lost my file. So I had to restart Excel. So the main topic for module 2 was how you estimate and forecast cash flows. For module 3, how you estimate the discount rate, the weighted average cost of capital. Knowing cash flows and knowing weighted average cost of capital, you can calculate the value of the project. Now, from the project, we are moving to the entire enterprise. And for the entire enterprise, we will use 3 different approaches to value the company. And the working horse of valuation for us will be the discount cash flow approach, which is very, very similar to what we were doing so far, to what we were doing before. So we calculate the free cash flow for the entire company. Instead of for project, it will be free cash flow for the entire company. And then we discount it to today, which will give us the value of the enterprise. The problem in this approach, and that's what we'll address in the very first week, is that we cannot really make forecast of the cash flow forever, because the company exists forever, right? But we cannot really make these forecasts forever. So we need to do some simplification. And simplification that is usually done is you take the limited period of time, which you call forecast horizon, and then after that limited period of time, you will stop and say, that's the end of my forecast. Let's say 5 years. After 5 years, I stop forecasting, and then I will estimate what the value of my company will be at the end of this forecast period. And I will call it like the terminal value. I realize the company will continue after that, but I would stop forecasting and I will make a simplifying assumption what this terminal value will be. And there are several approaches to do the simplifying assumption. And in this spreadsheet in tab growth and terminal value example, I'm discussing these several different methods, how you estimate the terminal value. And one estimate of terminal value is you simply look at the industry and use some matrix from the industry, for example, price-earnings ratio, and you use that in order to estimate what the terminal value of the company will be based on this terminal value expectation. Another approach, more commonly used, is that you would assume that after the end of your forecast horizon, you will continue growing at some constant rate, which will be called steady growth. And therefore, all the future cash flow will be assumed, it will be growing forever. And from your earlier finance classes, probably you remember that there was such thing as growing perpetuity. And therefore, what you will do, you'll apply this growing perpetuity formula to estimate the terminal value of the company. So for example, here we assume that free cash flow after the year 2022 will continue growing at the steady growth of 3%. And if the cost of capital, weighted average cost of capital, is 9.8%, then my terminal value here will be my cash flow from the next year. And this is this part of equation, C48, my cash flow in year 2022, multiplied by 1 plus the long-term growth rate. That is the estimate of my free cash flow in 2023. And then divided by WACC minus steady growth rate. That will give me the terminal value in the year 2022. And then if I want to find the value of my company, my enterprise, I will add this terminal value in the year 2022 to the free cash flow in the year 2022. So now I have a stream of cash flows, and then I will find the present value of these cash flows. And notice that this 2018 cash flow, I assume it is at the end of this year. So it's not at time 0, it is at time 1. And this is why I'm applying NPV directly, because otherwise I would have to take cash flow at time 0 outside. But here I assume that we're at the beginning of 2018, which we are, and my free cash flow will come almost 1 year later. I calculate the market value as the present value of these cash flows. But if I were to use the multiple approach, so then I would need the industry multiple. For example, in this industry, the multiple is 12. That would mean that I assume that my terminal value in year 5, in 2022, at the end of year 5, will be the cash flow in 2022 multiplied by this multiple of 12. And then I do exactly the same calculation, and I estimate that the market value will be, and you see it's slightly different. Because again, valuation is not the exact science. It's science and art combined together. So quite often we are talking about the possible range, not about one specific number. So this is this part is about introducing the terminal value and understanding its importance. And this is what next week you'll have to do. You'll have to do a homework trying to calculate what the value of the company will be. Notice again that's time 1 revenues, and you will use the net terminal value assumption here based on steady growth, and then you will see what percentage of the total company value in today's enterprise value, what percentage this present value of terminal value is. And you are here for surprise, I'm pretty sure, how large it is. And then for discussion, I would like you to discuss how sensitive this terminal value is to different inputs. For example, how sensitive it is to revenue growth, how sensitive it is to this terminal steady growth, how sensitive it is to WACC, or you might decide to look at sensitivity to some other parameters. That's okay. And an easy way to study sensitivity, if you have crystal ball working, you could use crystal ball and create tornado diagram and spider diagram in crystal ball, and you would be able to use them for sensitivity analysis. If you do not have crystal ball, that's okay. I perfectly understand. What you could do then, you could just manually see what will happen if your revenue, instead of 10%, your revenue growth will be 9% or 11%, how that will affect your NPV. You'll see the numbers and you'll discuss the results. And again, here are some examples of discount cash flow valuation of the company. Taxes are very important when company has leverage. And actually today, I mean this week, the discussion is about the value of the tax shield. And I'm looking forward to reading your submissions about this topic. And again, try to support your thoughts by some numbers to see what actual change the different capital structure will bring thanks to the tax shield. We will also have a discussion of another method which kind of related to discount cash flow, although it's simpler than that. And this is dividend growth model, when you'd assume that the value of the company is the present value of all future dividends. And I would like to hear your thoughts about this idea. That's one of the topics for discussion. And finally, the third valuation method that we will use is valuation using multiples. And the idea of valuation using multiples is very easy once you understand it. And that's why practitioners like it a lot, especially for companies that go public. They don't have a history of cash flow, so it's very hard to project future cash flows for them. And that's why quite often practitioners rely on valuations using multiples to estimate the value of the company. And what you do to value the company using multiples, you select similar companies from the same industry. These are your peers. And then for these peer companies, you know already their values. They are given because you can observe the price of these companies from Yahoo Finance, for example. You have financial statements for these companies, so you know what earnings of these companies were. You know what earnings before interest and taxes of this company was, EBITDA. You also know what the book value of the company is. And therefore, you can calculate different types of multiples. For example, in this. Hello. I know it sounds boring. Sorry about that, but it's an adult conversation. Sorry about that. So we have 4 different multiples, and for enterprise value, how you calculate enterprise value, you know the market value of these companies. Why don't I mute this very beautiful young child? Sorry about that, but I muted. You take the market value of equity, and then you add the book value of debt. And here we add short-term and long-term debt combined together, everything that generates interest. It is okay if you write a comment to add only long-term debt. That's okay, but you have to specify that for your homework. And then you will subtract the current value of cash. That's directly from your balance sheet. That will give you the enterprise value. Your earnings before interest and taxes, you look at your operating income before taxes, you add back interest, and you add back depreciation. That will give you your earnings before interest, taxes, and depreciation. That's a very common multiple that is used for companies that don't have profits yet when you take interest and taxes into account, but companies that have this ratio positive. Now, let me bring your attention to the fact that you can use ratios, these multiples. You can use them only if they are positive, and only if they are positive because both numerator and denominator are positive. You cannot use these ratios if they are negative, or you cannot use the ratios when both numerator and denominator, or either, well, actually both, are negative. Then your ratio becomes positive, but you still cannot use it because you had negative income and negative enterprise value. You do not use them, do not calculate the average using negative ratios. Only positive ratios can be included into the average. So I know the price, and I know EBITDA, I know my earnings per share, I know my market value of equity, again, market capitalization, I know revenues. That means I can calculate all kinds of ratios, and here as example, I use enterprise value to EBITDA multiple, price earnings multiple. Probably you've heard about it a lot. Very popular, very common, but earnings need to be positive for this to work. Market to book multiple, most of times, not in 100% of time, but most of times the book value is positive. That's why this ratio works most of times. And finally, price revenue multiple. Again, revenues are usually positive. That's why you can use this multiple. So what you do next, you calculate the multiple for each of peer companies that you have chosen. You calculate the multiple, and then you can even find the average of a particular multiple. So that's kind of the industry average that you have. And then, in order to find the value of your company, what you'll have to do, you'll have, for example, for EBITDA multiple, you have to take the EBITDA of your company, which you'll find from submitted financial statements. So even if company is not just about to go public, it will have to submit the financial statements for the last 2 years when it goes public. In its 424B4 statement filed with the SEC, you'll find these statements. Then you take this EBITDA and multiply it. So your company of interest, in this case, we are trying to find the value of Virgin America. So we are taking its EBITDA and then we multiply it by the multiple for JetBlue, and that will give me valuation of Virgin America based on JetBlue's multiple. The same for a different company. I can use this company's multiple, but I multiplied it by Virgin America's EBITDA. again, very common mistake. People don't realize you use your company's of interest item from financial statement, in this case EBITDA, and then you multiplied it by the multiple of the peer company, or you multiplied it by the average for the industry, multiples in average. And that will give you the valuation. And this is enterprise valuation. If I want to find the equity valuation, I have to do the procedure that is kind of the opposite to what we were doing here when we were trying to find the enterprise value. I have to add Virgin America's cash back. I have to subtract Virgin America's debt, and then it will give me the estimate of equity for Virgin America. And if I know the number of shares outstanding, and of course I do from financial statement, it will give me an estimate of the price per share. Now, I want to bring to your attention two very important points. Here, everything is in millions. Shares outstanding are in millions. Market capitalization is in millions. And my balance sheet is in millions as well. Pay attention to that. Very common mistake. People would not realize that their financial statement will be in 1 units, while the number of shares outstanding will be in different units. That would mean that you have to multiply some units by 1,000 in order to make them comparable. So if you get some crazy numbers for enterprise value, that would mean that probably your debt was in millions, but your equity was in billions. So you have to multiply equity by 1,000 to bring it back to millions. I don't have to here because, fortunately for me, everything was in the same units, but I saw this mistake so many times that I'm just warning you in advance. Please don't make this mistake. Again, two typical mistakes: using negative ratios. No, don't use them. Just exclude them from average calculations and exclude them from calculations here. And second mistake, make sure that all your units are the same. Millions or thousands or billions, they should be in the same units. So that's how you do multiples valuation. And for your homework, which is not next week, but much later, towards the end of Module 4, you'll have to download your company financial statements, your peers' financial statements. And here, I don't really know what items you will use, what items you will have. So I left this empty. So it will be your financial statements. And then here is a template how you make the adjustment and how you submit your homework. So 2 homeworks. Also, you'll start working on your module, a major project 2, hopefully sometime during this module 4. But I guess we'll talk about it some other time. So pretty much that's all I wanted to talk about today. If you have any questions, that's a good time to ask them. You can type them or you can unmute yourself and ask your questions via microphone. Okay, we did answer that question. If there are no more questions, then that's all I wanted to tell you today. Thank you. And have a good night. And bye-bye.